Have you ever looked at a financial risk report and wondered if it truly captured the full story of potential losses, especially when things go really wrong in the markets? While common metrics give us a good idea of typical risk, there is a deeper layer of understanding that sophisticated investors seek. Using conditional value at risk, or CVaR, instead of solely relying on value at risk, or VaR, offers a significantly more comprehensive and robust measure of potential losses during extreme market events. CVaR helps you understand not just how much you might lose, but on average, how much you would lose when those worst-case scenarios actually occur. Now let us break down why. Value at risk, or VaR, is a popular risk metric that estimates the maximum potential loss of a portfolio over a specific time horizon, at a given confidence level. For example, a 95% VaR of $1 million means there is a 5% chance that your portfolio could lose $1 million or more over that period. The strength of VaR lies in its simplicity and ease of understanding. However, its main limitation is that it does not tell you anything about the magnitude of losses beyond that specified threshold. It gives you a boundary, but not the depth of the chasm if you cross it. Conditional value at risk, or CVaR, addresses this critical blind spot. CVaR, also known as expected shortfall, quantifies the expected loss given that the loss exceeds the VaR. So, if your 95% VaR is $1 million, the CVaR might tell you that, on average, the losses that exceed that $1 million mark will be $1.5 million. This provides a much more granular view of what is often referred to as tail risk, which are the risks associated with extreme, low-probability events. For practical application, consider using CVaR whenever your primary concern is managing or stress testing for severe market downturns or extreme events. If you are a portfolio manager or a financial institution subject to stringent regulatory capital requirements, CVaR provides a more prudent estimate for capital allocation and risk budgeting. For individual investors, understanding CVaR can inform decisions about hedging strategies or asset allocation, especially if you have a low tolerance for extreme negative outcomes. Ask yourself, am I content with just knowing the point at which losses become significant, or do I need to understand the average size of those significant losses? An insider detail is that CVaR is generally considered a coherent risk measure, a mathematical property that makes it more desirable than VaR in many academic and regulatory contexts. For instance, the Basel Accords, which are international banking regulations, have moved towards incorporating CVaR for market risk capital calculations, recognizing its superiority in capturing tail risk. This focus on expected shortfall over a mere threshold highlights a fundamental shift in how advanced risk management is approached globally. Ultimately, opting for conditional value at risk offers a more complete and conservative picture of your investment portfolio's downside exposure. By understanding not just the threshold of potential loss, but the expected magnitude of losses in the worst-case scenarios, you can make more informed, resilient, and strategically sound decisions to protect and grow your capital, even when the markets are at their most challenging.